Right, good morning, good afternoon, or good evening, depending on where in the world you are catching us from. We've got over 4,000 people from 80 countries. So thank you so much for joining me today. It's really great to see all of you, and I really appreciate the fact that some of you have woken up really early to catch the broadcast, and some of you are staying up really late at night to catch this as well. So thank you so much for being here. I believe that some of you are here today because you want to create another source of income for yourself that is sustainable over the years. And some of you are here because you want to, you've got savings. You want to grow your savings at a much higher return. So you can build your net worth, your wealth a lot faster and be financially free from the rat race in the near future. So today I'm going to share with you exactly what it takes. And in fact, for the next 2 days, I'm going to share with you exactly what it takes and what you need to do to be a successful investor and trader. How do you achieve consistent profits from the financial markets, regardless of the economy, regardless of the politics? So today, I'm going to focus on investing in the stock markets, and how do you build a multi-million-dollar investment portfolio even on an average income, even if you're a beginner. And for tomorrow's session, I'm going to focus on trading, short-term swing trading to create monthly cash flow. And of course, joining me, I've got Bang Pham Van and Alson, who are great traders in their own rights. Bang's an options genius, and Alson is great at price action manipulation trading. So just to check that you can see me, you can see my slides, you can hear me. If you can, please give me a yes, type yes in the chat box so I know that we are good to go. Okay, thank you so much. I see a lot of yeses coming in. Thank you. Wow, it's really coming in really fast. Okay, yes. Thank you so much. All right. Give me a second. I need to sort out my windows so it's not that messy. Okay, cool. So let me begin with a bit of a disclaimer. I'm not a licensed financial advisor. I invest and trade my own money in my own capacity. So I can't tell you what to buy or what to sell. I can only tell you what I'm buying and what I'm selling. But you got to make your own decision based on your financial situation, your objectives, and your risk tolerances. All right. So with that, let's begin. So as of yesterday, the market, the US market measured by the S&P 500, it closed at 3,557, which means that the market is now up 10% for the year from January to November. So we started over here in January. We had a big crash in February because of COVID-19. And despite the crash, we are now up 10% for the year. Now, at the beginning of the year, I already said that this year is going to be bullish. We're going to end up positive for the year. And I got it right. Okay. Well, it's not because I'm a genius. It's not because I can predict the future. It's because I know that the market tends to go up most of the time. In fact, let's take a look at some of these statistics. So you can see that in the last 70 years, the stock market measured by the S&P 500 makes annual gains 74% of the time. So in the last 70 years, there were only 18 years that the market ended lower by the end of the year. And that's 26% of the time. But 52 years out of 70 years, which is 74% of the time, the market ended up positive. So every year, people ask me, Adam, do you think that this year the market is going to be up or down? And my answer is always the same. I always tell them the market is going to be up this year. Why? Because I know if I say the market is going to be up, I will be right 74% of the time. It's a no-brainer, okay? So never bet against the US market, because if you bet against the US market, you're only going to be right 26% of the time. But if you bet on the US market, you are going to be right 74% of the time. It's a no-brainer. It is really that easy to be profitable in the US markets. In fact, I'm here to tell you that even a blind, one-legged monkey can make money from the stock market. Okay, why? Now, even if you have got zero financial background, you know nothing about stocks, you can make money in the markets simply by buying the S&P 500 ETF, which is a fund, is an exchange-traded fund that tracks the S&P 500. So if you take a look at the last 10 years, from 2010 to 2020, despite all these crashes, right? The COVID crash, the trade war crash, and all kinds of crashes, if you just bought the ETF for the last 10 years, from there to there, you would have gained 198%. If you annualize it, that's 11.5% a year in terms of capital gain. But remember that you also get dividends. So if you add the dividends and you reinvest the dividends, in the last 10 years, you would have achieved 13.5%. Okay? So I tell people that the minimum that you should get from the stock market is at least 11 to 13% a year, even if you are even if you know nothing about the markets, right? So even a monkey could do this, okay? Now, are we going to do this? Are we going to do 11 to 13% a year? No, those are for monkeys. Those are for people who have got no idea what they're doing. They're just holding the ETF through the ups and downs. Now, we got pride, right? We've got pride. So our job in our community is to beat the market performance every single year. I'm going to show you how to do that in this webinar. Now, first of all, question. Do you think it is easy to beat the market? If you ask most people out there, they'll tell you, hell no, it's not easy to beat the market. Now, let's look at some very interesting facts. Fact number one, 80% of retail investors and traders lose money. That's crazy, right? 80% of people in the stock market lose money, despite the fact that the stock market always goes up. You can see in the last 120 years, from 1900 to 2020, the stock market has always gone up. Even with 2 world wars, the dot-com crash, Great Depression, financial crisis, pandemic, it always goes up, right? And I showed you earlier on that on any given year, the stock market gains 74% of the time. So why is it 80% of people lose money? Because 80% of people, they buy the wrong stock. They buy crap companies that are hyped up. And the worst thing is they buy at the wrong time. They buy it when it's high and they sell it when it's low. Duh. Okay. You buy high, sell low, you're going to lose money. You buy lousy companies, you're going to lose money, right? Now, you may say, okay, how about the professionals, right? Professionals should be doing really well. Professional fund managers. Bah, wrong. Here's fact number 2. Do you know that less than 10% of professional fund managers can outperform the index on any given year? That's right. On any given year, only 10% of professional fund managers can beat the index. And within a 5-year period, less than 3% of professional fund managers can beat the index. 3%. Okay. So that's really, really sad. Okay. Now, the great thing is that my students and I believe it's very easy to beat the market. And we have got the proof to show you because we'll be doing it every single year. So here are some of my students, and I get these messages every single day. This is from Ahmad Farah. I hope I'm pronouncing his name correctly. He said, "Hi Adam, I'd like to thank you for all your teaching and guidance. I'm up 200%, 204% on my IB account this year, despite the COVID situation, investing in the right stocks. This is Emil Hansen. He said, "Hi Adam, I don't even know how to begin." That's his performance over here. I got 90% return year to date on my Interactive Brokers account. And then we have got Bagus Suntoro Utomo from Jakarta, Indonesia. And he's been following me for 10 years, beating the market every year in the last 10 years. Right? He said, "Adam, thank you so much for your and Bang's teaching and guiding us to all of us profit from the stock market." In 2019, he was up 127%. My portfolio gained 71% year to date this year, 126% in 1 year. In total, from January 2019 to October of 2020, I'm up 259%. We've got Gustavo from Argentina, right? "Adam, thank you very much for your coaching. Very proud to be part of the team. Up 40% for the year, for 12 months, and up 29% year to date." We've got Evelyn from Singapore saying that, "I'm very glad in less than 1 year, my portfolio is up 27.8%, beating the S&P 500's ass." I like this girl. She's got spunk, right? And of course, my own account, I'm managing several accounts. One of my accounts, you can see I'm up 43% for the year. That's about 1.5 million. And my other account up 48% for the year. So I'm showing this to you not to show off to you, but to tell you that my students and I can beat the market every single year consistently. Now, how are we able to do this? Can we see the future? Do we have lucky charms? No. It's because we follow a very strict methodology that works. So how do we beat the market consistently? How do we achieve 20% to 40% to even some of my students 80, 90% a year consistently? We use a method which I developed over the years. And my method is called value momentum investing. So I'm going to teach you this method today to understand the concept. So we call this VMI. And value momentum investing, basically, it's all about only buying the fundamentally strongest stocks in the market. I repeat that. We only want to buy the fundamentally strongest businesses in the market. And that takes a lot of discipline. So we don't chase hype stocks. We don't listen to opinions of experts. We only buy great businesses. And we only buy them when they are significantly undervalued and when they are having strong price action momentum based on the technical charts. And that's how we beat the market every single year. So let me show you how the right company outperforms the market easily. So again, if you take a look at the last 10 years, now the last 10 years, this is the S&P 500 index. The index is basically a basket of the 500 biggest companies that represent all the stocks in the market. So if you just buy the index ETF and you just hold it through the ups and downs, you will already make money, right? You'll make 11 to 13% a year, as you can see, very easily. But if you know how to select the best companies, you can beat the market easily. So let's take a look at 3 of my favorite companies over the years. You have got Microsoft, you've got Apple, and you've got Amazon, to name a few. So you can see that when you buy great companies, it flatlines the S&P. It makes the S&P look like the bank interest fixed deposit, all right? In the last 10 years, Microsoft has grown at 543%. That's about 20% a year, excluding dividends. If you add the dividends, it's a lot more, right? Apple has increased 1,000% in the last 10 years. That's 27% a year. Amazon, the clear front winner, up 1,600% in the last 10 years. That's 33% a year. So again, you buy the best companies, you easily outperform the market with 20, 30, 40% returns. Now, am I saying that you should go and buy these 3 companies right now or right away on Monday? No. Although they're great companies, it doesn't mean that you buy them on Monday or Tuesday, right? Why? You see, to be a successful investor, there are 4 keys that you have to know, right? There are 4 keys. Number 1 is you have to know exactly what to buy, right? Guys, write this down. As I'm sharing these ideas with you, take lots of notes, okay? So write this down. Number 1 is what to buy. By the way, feel free to ask questions on the Q&A chat, and my team will be answering your questions live. And I'll also be doing a live Q&A at the end of the webinar, where I'll answer all the questions that have not been answered. And of course, at the end of the webinar, we have a special crazy sale where you'll be able to get our courses and playbooks at 60 to 65% discount for a very limited period. So that's at the end of the webinar. So for now, take lots of notes, ask questions, and stay engaged, all right? So again, number 1, what's the first key to successful investing is to know exactly what to buy. So what do we buy? Now, remember, when you buy a stock, you are not buying a lottery ticket. You are buying a piece of a business. Always remember that. You're buying a piece of a business. So we only want to buy the best businesses that are available in the market, the best of breed businesses. So later, I'm going to show you my criteria. How do I select a great business? And we're going to do a live analysis on a stock that you have chosen, which I'll reveal in a while, all right? And I'll also run through all the different stocks that you have requested, and we'll see if they're great businesses or not, right? So stay tuned for that in a while, right? So number 1, you got to know what to buy, right? But number 2, you have to know exactly how many shares to buy. That's what a lot of people don't know. They say, yeah, I know what to buy, I don't know how many shares to buy. Okay? Now, you never put all your eggs in one basket. You have to diversify over at least 10 great companies, So how many shares do you buy for each company? There's a formula on how to diversify your risk. So we'll talk about that later on, all right? Number 3 is you must know exactly when to buy. When to buy. Now, remember, a great business, a great stock can be a bad investment if you pay too high a price for it, if you buy it at the wrong time. But a great business can be a fantastic investment if you pay a low enough price for it, if you buy it at the right time. So when is the right time to buy a stock? You only buy a stock when it is undervalued, when the price is selling below its true intrinsic value. And again, I'll show you examples of how I calculate the intrinsic value. And we only buy a stock when it's on a clear uptrend and it's at a support level on the uptrend, so there's momentum of the price going up as fast as possible. Got it? Okay. Number 4 is to know exactly when to sell. Trouble with most people, they say, I know what to buy, I know when to buy, I don't know when to sell, right? So you gotta know when to sell. You gotta know when to get out, right? So again, more on that later on. So again, write this down. WHWW, okay? What to buy, how much to buy, when to sell. Let's go through these steps right now. So let's focus on the first step, which is knowing what to buy. So again, step 1 in value momentum investing is you must know how to identify the fundamentally strongest stocks in the market. To give you an idea, there are altogether 4,000 companies available in the US, 4,000, okay? before I invest in a stock, it has to pass my 7-step criteria. I've got a 7-step criteria before I know a stock is good enough to invest in. Now, I want you to make a guess. What percentage of stocks are investable? What percentage of stocks meet my criteria? I want you to guess and type it in the chat. So I want to get some responses right now, okay? So AC says 2%, Nicholas, oh, that's a bit too fast. Ziwei says 5%, John Victor says 5%, Angus says 5%, Aryan says 1%, Chris says 1%, Marcus 3%. Let's see. Keep it coming, guys. What do you think? What percentage of stocks are investable? Okay, Richmond says 10%, Susie 5%, John Cervantes 10%. Okay, Asher Chu 3%. Okay, got a lot of different responses. The answer, write this down. For me, only 1% of stocks are investable. Only 1. Which means out of the 4,000 companies in the US, only 40 companies are investable. The rest are not investable. I mean, you can trade them for the short term, but to invest it, no, only 1%. Now, do I buy all 40 companies at any point of time? Of course not. At any point of time, I will only have maybe about 20 or 30 companies in my portfolio, which means that I only buy the top 0.5% of stocks at any one time. Write this down, the top 0.5%. So if you are really disciplined and strict and only buy the best of the best, you can't lose money. You will definitely make money. The only question is how much money, right? Okay. So what are my criteria? What qualifies a business to be the top 1%? Let's take a look at some of my criteria. Number one, I only invest in companies with a solid track record. I only invest in companies with a history of consistently increasing sales revenue, net income, and cash flow from operations for at least 5 years. Write this down, at least 5 years. So in other words, for the last 5 years at least, I want to see the company increasing the sales revenue consistently, selling more and more products and services every single year, recording higher profits every year, generating positive cash flow from operations consistently. Now, do you think all companies meet my first step, my first criteria? No. In fact, I can tell you that less than 5% of companies in the world can pass the first criteria. That's right, less than 5%. Which means if you just apply the first criteria, it will eliminate 95% of all the stocks in the market. This is the first step. Okay. Now, step two, we're going to get even stricter, right? Step two, I only invest in companies with a sustainable competitive advantage that protects it from competitors. So in other words, I invest in companies with a wide economic moat. Now, this is the most important step, bar none, of all. Write this down. As an investor, you want to buy companies with a wide economic moat. Now, what the heck is a moat? Remember in the old days, kings live in castles, right? And how do they protect the castle? They build a moat around the castle, the water barrier. And they put lots of crocodiles and piranhas in the moat, right? So same thing, when you invest in a business, you want the business to have a lot of crocodiles and piranhas, protection, so that competitors are not able to replicate the products and services. Competitors are not able to come and take away your customers. That's a great business. So when a company has a powerful competitive advantage. It's able to raise prices every single year and not lose customers. When a company has a sustainable competitive advantage, it's able to fend off competitors. But when a company doesn't have a strong moat, what happens? It always competes on price. The lowest price competitor wins. So it can't raise prices because the moment it raises prices, it loses customers. If competitors cut prices, they will lose market share. We don't want those kind of businesses. When a business doesn't have a wide economic moat, what happens? It always competes on new features. So if a competitor has a new product with better features, guess what? Your business will lose customers. We don't want those businesses. We only want to invest in businesses with no competition. Write this down. Write this down, guys. We only want to invest in businesses with no competition or with insignificant competitors. Either insignificant or no competition. Now, what kind of companies have these characteristics? Number one, companies with a brand monopoly. Check it out. Can you see this word over here? Brand monopoly. What's a brand monopoly? It means that the moment you mention this product, most people would think of the same brand, or most people would use the same brand. It's what is called top of mind recall. Okay. Now, let me play a game with you. Let's play a game, guys. I'm going to go to my charts right now. All right. And I'm gonna mention a product category. And I want all of you to type the first brand that you think about or the brand you use. Are you ready? Okay, so play along. The first product or the first service, search engine. When I mention search engine, what's the first thing you think about? Come on. That's right. Google. Absolutely. There's no competition. Google's a brand monopoly. There's no other competitor, right? If I mention free videos for education, for entertainment, free videos, what do you think about YouTube? There's no competitor. Don't tell me Pornhub, all right? Now, who owns Google? Who owns YouTube? It's owned by Alphabet. So Alphabet is a brand monopoly. Now, if you take a look at any brand monopoly, they have got one thing in common. If you look at a 10-year stock chart, it always goes up. It's always going up. So check it out. So let me key in right now. Alphabet. There you go. This is the last 10 years. Hallelujah. It just goes up because there's no competition. There are no competitors. You only want to buy these businesses. Okay? Let's do it again. If I mention social media, what do you think about, guys? Social media. That's right. WhatsApp, Instagram, Facebook, Twitter is insignificant in terms of market share. TikTok is insignificant. Facebook is the brand monopoly. So again, if you look at Facebook in the last 10 years, what do you see? Hallelujah. It just goes up. There's no competition. Okay, let's play another one. If I mentioned fried chicken, come on, fried chicken. That's right, KFC. How dare you say Popeyes? KFC, right? Pizza. What's the top of mind recall? Top of mind recall, pizza. Either Domino's or Pizza Hut, right? So dine-in, Pizza Hut. Home delivery, Domino's, right? So who owns Pizza Hut and KFC? It's owned by Yum Brands. So if you look at Yum Brands, there you go. Hallelujah. Right? So clear up trend. If you look at Domino's Pizza, right? Check out Domino's for the last 10 years. So Domino's Pizza, check it out. Whoa, that's a lot of pizza, guys. So it's a no-brainer. So guys, remember, only buy brand monopolies because they've got no competitors. It can only go up, okay? But so there are certain industries I will never invest in. Why? Because these industries have a lot of competitors, like airlines. I'll never invest in airlines because there's so much competition. They're all fighting with each other, right? I'll never invest in oil and gas or energy companies because, again, it's very price competitive. It's too much competitors. I'll never invest in real estate developers. I'll never invest in automakers. I'll never invest in contract manufacturing. I'll never invest in construction, because there's no one monopoly. So, for example, if you take a look at oil and gas, right? A good example is ExxonMobil. If you look at ExxonMobil, in the last 10 years, that's what you get. Why? Because of competition, okay? Now, let's go back to our slides over here. Okay. Now, besides a brand monopoly, I also want to invest in businesses that have a high switching cost. Write this down. Very important, high switching cost. What does this mean? This means that the moment a customer uses the product, it's very expensive to change to a competitor's product, or it's very difficult to change to a competitor's product. So they are locked in to the company for a lifetime. Okay, so an example would be Adobe. Have you heard of Adobe? What does Adobe make? Adobe makes software for designing, right? Adobe Photoshop, Adobe PageMaker, Adobe After Effects. Now, designers go to design school for 3 years to learn designing using Adobe software. After they graduate and they start working, will they change software? Of course not. They spent 3 years learning the software. So for the rest of their life, they'll be using Adobe, paying licensing fees forever. So Adobe locks in the customers. Hence, if you look at Adobe, look at the chart for the last 10 years. There you go. Hallelujah. There's no competition. Another example would be Microsoft, right? Why? Now, if I mention Office software, what's the top of mind recall? Microsoft. So Microsoft, number one, is a brand monopoly. Number two, it has high switching cost. Why? Because once you use Microsoft Word and Microsoft Office, we are so used to using it that it's very difficult to change to another software because we have to relearn everything all over again. So we are locked into Microsoft Office for the rest of our life. All right? Now, not only that, but Microsoft has what we call the network effect. The network effect means that we use it because everyone is using it. And if you don't use it, it's hard to share files. So it's a network effect. Hence, if you look at Microsoft, same thing. They lock in the customers, they've got no competition, and the stock price, hallelujah, just goes up. Does that make sense? It's so simple. Buy brand monopolies, buy companies with wide moats. Got it so far? Okay, let's move on, guys. Next. Only invest in companies with huge growth potential. Companies that are in industries that are in a secular growth industry. Now, what's the meaning of secular growth? Which means that this industry is growing for the long run. Even during short-term recessions, these industries still grow, like e-commerce, social media, search, software. These are secular growth industries, right? What are not secular growth industries? Like oil and gas is a sunset industry. You don't want to touch oil and gas because there's no secular growth. Those are what we call cyclical industries. Cyclical means it goes up and down depending on the economy. But secular growth means regardless of the short-term economy, the industry will still grow. Like biotechnology, for example, artificial intelligence, cloud computing. These are secular growth. So invest in companies with secular growth potential. Okay. Now, next, conservative debt. Now, here's the thing, guys. Some companies are able to make a lot of money, but to make a lot of money, they have to take on a lot of debt. They have to take on a lot of debt because their company requires a lot of capital investment in factories, in plants and machinery. Personally, for me, I avoid those businesses. Okay, I only like to invest in businesses with little or no debt, and with a lot of cash on their balance sheets. Why? Because when a company has a lot of debt, even if they can make a lot of money, it's risky because when it comes the day they can't refinance their debt or interest rates rise too fast, what happens? That's right, they can go bust. They can go bust. But if your company has no debt, it's hard to go bankrupt if there's no debt. Does it make sense? Okay. And that's why for me, for example, I will never invest in Tesla. Yeah, people lose their shit when I say that. How can you not invest in Tesla? It's sacrilegious, you bastard. Okay. Now, let me just say that for Tesla, I do trade it short-term using options. I trade it as a one-night stand using options, but I'll never invest in Tesla as an investment. Why? Because Tesla has a lot of debt. It's got really high debt. It scares the shit out of me. In fact, Elon Musk himself said that back in 2017, 2018, Tesla was 1 month away from bankruptcy. That's right. That if they couldn't refinance the debt, they would have gone to zero. Okay? Now, so I will not invest in Tesla because of the high debt levels. And that's just me because, you know what? I'm a chicken. I'm very conservative. You know, now let me give you an example over here, right? Let's imagine there are two companies. Give me a second. Let me bring up the chat. Okay. Let's imagine there are two companies. We've got company A and company B. Company A is a hot stock. Everyone is talking about it. It's a cult stock. People love the CEO. Wow, it's exploding. And so company A could rise 50% a year. Okay? But company A is really overvalued. It has a lot of debt. And the CEO is on drugs, literally. Okay? He's high. Okay? And there are a lot of potential competitors. So, you know, if things go wrong, it could drop 70% or even go bust. All right? On the other hand, company B is not that hot. It's not that exciting, but it's very predictable. It's a monopoly. It is fairly valued. It's got little debt. So company B maybe would go up, say 20% a year. Okay, less than company A. But because company B has no debt, it's undervalued, it's very safe, there is no downside. Even if the share price drops temporarily, it will go up again. Okay, so let me ask you a question. Which one would you rather invest in? A or B? You tell Uncle Adam. You tell Uncle Adam which stock you rather buy. Which one you think is good for your portfolio? Okay, that's right. So most of you say B, right? Me too. We are friends. So can you guess what kind of stock is company A? What kind of stock is company A? What kind of stock is company A? You tell me now. Zoom, that's right. Tesla. Neil. All right, these are company A stocks. Yes, it can go up like crazy, but you know what? It can also die. When will it die? I don't know, but it could die one day, right? Company B would be companies like Google or Alphabet, right? Companies like Microsoft, for example, okay? So you see, for me, I would never invest in company A. You know why, guys? Because I'm a chicken. I admit it, I'm a chicken. I'm really conservative because, see, I follow the two rules in investing that I learned from Warren Buffett. Rule number one, Write this down. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. So, for me, I rather not make money if I have a chance of losing it. I repeat that. I rather not make money if I have a chance of losing it. So, something, guys, I've been in the markets for the last 28 years. For the first 8 years, I did all the stupid things. I made all the stupid mistakes in the first 8 years. But for the last 20 years, I have never lost money on an investment before. In the last 20 years, my win rate has been 100% in investing. I always make money in every investment. Now, it's not because I'm good. It's not because I'm lucky. It's because I'm very, very conservative. I only buy the top 0.5% of companies that are company B. Does that make sense? So it's not always about return. Don't think about how much you can make only. Think about how much you can lose before how much you can make. It's all about the risk to return ratio that you got to think about. All right. So I need to understand that about me, that I'm a very conservative person. Now, again, but would I do a short-term trade on Tesla or NIO? Sure. But that's short-term trading. I'll talk about that tomorrow using options. But for investing, no way, Jose. All right. Okay. So just bear it in mind. Now, of course, there's a lot more criteria, but these are the key ones I want you to take away today. Now, here's the thing. Once you identify a good business that has no competition, that has got a great track record, that is in a secular growth industry, then you are confident that over time, the company will increase in value. All right. So this green line represents the intrinsic value of the stock. So in a short while, I'll show you how I calculate the intrinsic value. So let me repeat that. When you buy a good business, you know for a fact that the intrinsic value will rise every single year because the company makes more and more money, more and more cash is worth more and more. Make sense? Okay. But do you think the stock price will go up every day, every week, every month? Yes or no? No. Why? Because stock prices in the short term are all manipulated. Let me say that again. In the short term, stock prices that you see are all driven by manipulation, by market makers, by algo traders, by robots. In the short term, prices are driven by emotions, not logic. They are driven by emotions that are driven by short-term news. So whenever there's good news, what happens? The price can fly to ridiculous levels, right? So the red line is the price, right? So there's good news. Yeah, all right. Oh my God. And the share price can be way above the intrinsic value. But sure enough, there'll always be bad news. Some kind of bad news. Hey, there's a trade war. Oh my God. The US and China at war. Ah! Hey, they came to agreement. The war's going to be over. Yes. But wait, now there's a pandemic, COVID-19. Oh my God. Hey, but wait, there's a vaccine. Yeah, vaccine. Vaccine won't work. Oh my God. Yeah. All right. So that's what drives the market up and down in the short term, like a roller coaster. Now, we call this volatility. Question. Do we like volatility? Yes or no? Yes. As an investor, I love volatility. Uncle Adam loves volatility. Why? Because volatility creates the temporary mispricing of the business. Write this down. Volatility creates the temporary mispricing of the business. That because of this crazy manipulation, there are times when the share price could be selling at a ridiculous discount, which means that you know that the stock is worth $100, for example, but temporarily it could be selling at $50, and that's a 50% discount. It's a steal. You're buying something at a steal. But at the same time, the stock could also be selling at $200 and is overvalued because of hype. So, question, where do you want to buy shares? Do you want to buy in area B or area A? You tell me. Everyone says B, right? That's what you all say, right? But in reality, guess what? Most retail investors always buy at A. They always get in at A. Why? Because A is when you have all the good news. Hey, vaccine, the market is going up and people jump in. Freaking idiots, right? You know, A is when company releases great reports, great. So when there's a lot of good news, people feel confident, they feel optimistic, the media says buy, and they jump in when it's overvalued. And guess what happens after that? That's right. What goes up must come down and drops. They go, oh my God, why? And they sell, and they always lose money because they always buy high and sell low. Okay? So if you want to succeed in the markets, you got to do the complete opposite of the average guy. That's right. So we want to buy at B. Now, what happens at B? At B, you got all the bad news. You read the media, they tell you the market is going to crash. YouTube videos say that we're going to collapse. It's a recession, it's a pandemic, it's a depression. Oh my God. So when everyone is panicking and shitting their pants, that's when we buy. We buy when it's undervalued. Because we know that when we buy a great business that is temporarily undervalued, very quickly the price would revert a lot higher because the valuation is actually going up. Does that make sense? So let's take a look at a few examples right now. Okay, so one of my favorite companies is Microsoft. I explained why earlier on. White mode, right? Brand monopoly, high switching costs, network effect. Does it meet my criteria? Let's check it out. So first thing, track record. Look at the revenue, guys. Look at the revenue. This 2016, 2017, 2018, 2019, 2020. 91 billion, 96 billion, 110, 125, 143. What do you notice? That's right. Every single year, the sales increase. Regardless of the trade war, regardless of the pandemic, it grows every single year. That's what you want. Look at the net income right here. Net income after taxes, 20 billion, 25, 30 billion, 39, 44 billion. It's making more and more money every single year, regardless of the pandemic. Okay, it's a secular growth company. Next, look at cash flow from operations. Where's that? So cash flow from operations over there, again, 33 billion, 39 billion, 43 billion, 52 billion, 60 billion. So you know that this company increases in value every single year. Question, is a great business? Yes. I told you, a great business can be a bad investment if you overpay for it. So you want to pay a price that's below its true value. So how do we calculate the intrinsic value? There are many ways to do it, But the most comprehensive way is doing a discounted cash flow analysis. So with that, we have what we call an intrinsic value calculator. This is a calculator that is part of our value momentum investing programs. And for people who join my subscription service, basically I calculate all these valuations for them every 3 months, right? I do everything for you if you want, or you can get a calculator and calculate it yourself. It's really simple. It takes less than 5 minutes. And all these numbers, you can get it from Yahoo Finance. Many free websites to get all these numbers. But let me show you what are in the numbers, right? So the first thing that we have to key in would be how much cash flow the company is generating from its business. So for the last 12 months, Microsoft generated 60 billion in cash. 60 billion in cash, right? Next, how much debt does the company have? So the total debt of the company, 63 billion in debt. But how much cash do they have in their bank? In their balance sheet, they have 136 billion in cash. So again, they've got more cash than their debt. They can easily pay back all their debt if they wanted to, right? Next question, what's their growth rate? So we have to look at the projected growth rates that are analyzed by analysts. You can get this again from Yahoo Finance, it's all there, right? So Microsoft is now growing at 15% a year. We can't assume that they will continue at 15% indefinitely. The growth will slow down over time. So we're going to assume that first 5 years grows at 15%, next 5 years halves to 7%, and the final 10 years it grows at 4%, which is the GDP growth rate of the US plus inflation. Next, put in the number of shares. So you put in all these numbers and you will calculate that the intrinsic value of Microsoft is, ta-da, $221. This is the secret sauce to investing. It's a secret sauce because once you know the true intrinsic value, you know exactly when to buy and when to sell. That's right. So we want to buy when the share price is selling below this intrinsic value. Does it make sense? So let's take a look at this chart over here. Again, like I showed you, over time, the intrinsic value would rise. The green line would always go up. But the share price goes through cycles depending on news, right? So good news, bad news, good news, bad news, good news, bad news. Oh my God, it's so good. I love it. Oh my God, I'm gonna die. Oh yes. Oh. So again, when do you buy? You buy here when the price is below the intrinsic value. Now, people ask me, okay, how low is low, Adam? Roughly, let me give you some rough figures. I like to buy only when the price is selling at least 10% below the intrinsic value, at least 10%. So when it's 10% below, I start buying a bit. When it gets 20% below, I buy more. When it goes to 30%, I buy everything that I have for this company. So in investing, you never buy all at one time. You buy in stages. You average in your position. Does it make sense? Okay. So you can see that back in February, during the stock crash, Microsoft dropped, right, all the way to $133. When the intrinsic value is $220, right, that's about over 30% discount. Now, did I buy exactly at 133? Of course not, right? No one can catch the absolute bottom, right? So I bought at roughly about 145. My average price about 146. Okay. So people ask me, Adam, how did you know exactly when to buy? I look at support levels on the charts. So using the charts, I look at support levels and I buy at support levels. So let me give you an example of how I read that, right? So first of all, let me show you my account. Okay, this is my Interactive Brokers account. Right now, it's down for maintenance, so it's not loading properly. But take a look over this, over here. Microsoft. Can you see my position in Microsoft over there? Let me make it a bit bigger for you guys. Yeah. Yeah, so this is my live account. It's a $1.5 million account. So you can see Microsoft over here, my average price that I bought at, average was 146. So right now it's at 210. And so again, how did I get in at that average price? Why did I buy at 146? Okay, so let me show you the charts so you understand that concept, all right? Okay. So what I do is I put in what are the moving averages, like so. All right. Now, remember, when you buy a great company, the share price will always go up. It will always go up. If the fundamentals are rising, the share price will always rise eventually. But the price doesn't go up in a straight line. It rises in a pattern of waves. So these are what I call the wave patterns. Okay. So wave up, wave down, wave up, wave down, wave up, wave down. And the pattern continues, right? It's kind of like a breathing pattern. So breathe out, breathe in, breathe out, breathe in. Question, can you breathe out forever? No, you will run out of air, right? So you breathe out, right? Eventually what happens? You're going to breathe in and breathe out, okay? So remember that. Now, when do you want to buy a stock? When you want to buy? Do you want to buy during the breathing in at A, or do you want to buy breathing out at B? Tell me, A or B? That's right. You always want to buy at A. You always want to buy during a wave down. Write this down. Write this down, guys. You only want to buy during a wave down, breathing in, enter before the wave out, before the breathing out. Get in before the breathing out. So question people ask would, Adam, how would I know it's at A? How would I know the breathing in is over, it's going to breathe out? How do I know? Okay, now we can guess. We can't always be 100% right, but we can guess using moving averages. Let's take a look at this, right? Now, one thing you have to understand is that a market breathes in shallow, shallow, and deep, right? Let me show it to you, right? So shallow, 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 deep breath. Shallow, shallow, deep breath. Now, these deep breaths happen once every 5 years normally. They don't happen that often. Once every 5 years, you have a deep breath, right? But once every year, you will have a shallow breath on average, okay? So take a look at Microsoft, right? And this is the long-term chart. What do you notice? Notice that every time it takes a shallow breath, it will find support at the red dotted line. That is the 20 exponential moving average on weekly candles. Can you see that? Let me show that to you again. You can see, breathe out, breathe in. Hits the moving average, breathe out, breathe in. Hits the moving average, breathes out, breathe in, hit the moving average. Can you see that? So it bounces off the red line. Now, this was a deep breath because the trade will breathe out, breathe in, boom. In a deep breath, it hits the blue line, which is the 50 moving average on weekly candles. The red is the 20 moving average. So again, breathe out, breathe in, toing there, breathe out, breathe in, toing there. Can you see that? So every stock has its own unique pattern. You have to know that for that stock, which moving average does it respect? So you buy once it hits the moving average before it breathes out. Okay. So what happens was that in February, during the COVID crash, the market was going down, going down, going down, going down. So how did I know where to buy? That's right. I was waiting for the blue line. I said, this is a deep breath. This is a bear market. I will buy the moment it hits the blue line. So the moment it hits the blue line, boom, that was 146. Right? So I bought at 146 right there, as I showed you a while ago. And sure enough, what happened? 146 buy and then breathes out. And then again, breathes in, boom, 20 moving average, breathes out, boom. So right now, you can see it's taking a shallow breath at the 20 moving average. So that's where we add the shares. Does it make sense? Give me a slight second. Sorry about that technical issue, guys. I had to sort something out. Yep. Okay, we're back. Are you just to check that you guys can hear me right now? Okay, we're good. Okay, so that's exactly when we enter the stock. Okay, so let's move to there. Okay, so let's run through the steps once again. Okay, so again, step one is identify the fundamentally strongest stocks, the best of the best in the market. Okay, step number two is you got to be patient and you got to wait for temporary bad news. When the price drops and you buy when it's undervalued at a support level on an uptrend. When it breathes in, you enter before it breathes out. Okay. Now, step three is you must learn how to build a diversified portfolio, a low risk, high return, diversified portfolio. Because like I said, no matter how good a company is, don't put all your eggs in one basket. You have to diversify into different kind of companies, and I'll be going through that in detail in a short while, so hang on to that. Okay. Step four is you must know when to sell. So for investing, when do we sell an investment? There are two reasons to sell. Number one is when the stock becomes way overvalued. There's nothing wrong with taking profits and redeploying the cash. So for example, 2 days ago, I took profits on Estee Lauder, you know, the beauty company, right? So I bought it when it's undervalued. Now it's way overvalued. So I took profits, I took the money and I redeployed it into another company, which I bought. All right. Another one is booking.com. I bought it when it's really undervalued. Now it's a bit expensive. I took profits on it as well and redeployed the cash. And I'll show you my alerts in a short while that I send to my students, right? You also get out of a stock the moment it's no longer a great business. Now, remember that a business is not great forever. Nokia was a great business, not anymore. General Electric was a great business, not anymore. So you got to know exactly when the business is no longer a great business and got to get out, right? So these are the things that I teach in the value momentum investing course. How do you analyze the business and get out before everyone else? Even before the reports come out to show a drop in profits, you got to get out way before that, right? And these are things that I teach in my community, right? Okay. So let's learn the next thing. So guys, like I said, as an investor, you need to have a portfolio of at least 10 companies, at least 10. But you can go up to like 15 or 20 or 25, but minimum 10 companies. Why? So that you have a balanced portfolio. Think of it kind of like a meal. You know, to be healthy, you need a balanced meal. You can't just eat protein all the time, although protein is really good for you, right? You need protein, you need carbohydrates, vegetables, and vitamins. You need a balanced diet. So same thing with your portfolio. It has to be balanced. Let me give you an example. Now, how many of you know that about 2 weeks ago, technology companies started coming down, right? Microsoft and Apple and Tesla started coming down. Have you know that? Right? And as they started coming down, what went up? Cyclical companies went up, right? Banks went up. Industrial companies went up. Okay, we call that sector rotation. So those people who only invest in technology, guess what? Their portfolio would have dropped in value in the last 2 weeks because all their stocks are concentrated in those tech companies. But during that time, my portfolio went up. Why? Because while my tech stocks went down, my bank stocks, my insurance stocks, my cyclical stocks went up. Okay, and it went up more than my tech stocks went down. So in the end, my portfolio grew consistently. So the key to consistently growing your portfolio is to have a balance. So when one goes up, or rather, when one goes down, the other one goes up to balance it off. Does that make sense? Very, very important, right? Okay. So what kind of companies should we have in our portfolio? Now, I divide stocks into 6 main categories, as you can see over here: large growth, defensives, cyclicals, speculative growth, turnarounds, and dividends. All right, so let's go through them one by one right now. The first type of company or stock that we can buy, I classify them as large cap growth stocks. So these are huge companies that dominate their industry that are growing at least 20 to 30% a year, right? So large companies, at least 100 billion in market size in secular growth industries, growing at 20 to 25% a year. And these companies have consistent growth in sales, net income, and cash flow from operations, regardless of the economic cycle. Okay? They have wide economic moats, brand monopolies that protect them from competition, and they are in, again, secular growth industries like, e-commerce and fintech, health tech, social media, cloud computing, and so on and so forth. Now, usually, the share price is expensive because these are great companies, right? But we need to be patient and buy them when they're temporarily cheap during bad news, like the trade war, like the recent sell-off, right? Does it make sense? Okay. So you guys tell me, can you name some companies that you think fit the first category? What do you think, guys? Type in your answer. Name me some companies that fit the category. Okay, people say Alibaba, correct. Alibaba, Apple, Microsoft, Alphabet, correct. Amazon, correct. Johnson & Johnson, no, not Johnson & Johnson, because Johnson & Johnson is not a growth stock, right? It's not a growth stock. Adobe, correct. 3M, no. Disney, no. Okay. Netflix, yes. Netflix, I would agree. Netflix, yeah. Facebook, yes. General Motors, you got to be kidding. Abine, right? PayPal, well, maybe, right? But yeah. Zohai, correct. VEEV, correct. VEEV, right? NVIDIA, yeah. Okay, correct. All right, great. So basically, let me give you some examples. These would be the MAGAF stocks. MAGAF. What does MAGAF stand for? Oops, sorry, a bit fast over here. These are the MAGAF stocks. So MAGAF would be Microsoft, Apple, Alphabet, Amazon, and Facebook. Okay. In China, you have got Tencent, which dominates social media. It's their version of Facebook and Instagram and WhatsApp, right? You have got Alibaba, obviously. Okay. And you've got like Meituan, and you got some other companies like VEEV. In fact, this company was a company that I started buying about a year ago, and an alert was sent to all my students. All right, you can see over here. Those of you who are in my Ultimate Investors Playbook, this is a subscription where you get to watch my live account. Every time I buy something, I sell something, you are notified of it immediately. All right. So this was back on March the 2nd. You can see that I shared with my students. I just added VEEV at $140 at the support level, right? So this was March the 2nd at 140. Let's see where it is right now. right? So I entered, let's see, March. Yeah, over here. March the 2nd, right? And after I entered, sure, it went down initially because of the COVID crash. No one could predict it. But since then, it's now at 274. All right. So it's about 100%, yeah, about 100% gain in less than 1 year from this position I entered. All right, so that was a great investment actually. So yeah, Vive is an example of a large cap growth company, right? Okay, the second category are large cap defensive stocks. So notice I use the shield as a representation, right? Defensive stock. So now these are companies where they sell a product or service that never goes obsolete, like alcohol, right? You think about alcohol today, beer, wine is the same as 100 years ago. It never goes obsolete. Toothpaste today and 100 years ago is still the same toothpaste, right? Soft drinks today and 100 years ago, they're still the same soft drinks, right? So these are companies where they sell a product that tends to be defensive. Now, defensive means that they are essential items, which means regardless of the economy, you have to still buy toothpaste, you still buy batteries, you still buy sanitary pads, you still buy potato chips. Okay, so these are essential items that are defensive and they've got very low uncertainty in earnings and cash flow. So regardless of good and bad times, their sales and profits rise consistently. They have got wide economic moats with little or no competition, slow but steady capital appreciation. But these companies, unlike the growth companies, they don't grow at 20 to 30%, right? So toothpaste companies don't grow at 20, 30%, right? You know, PepsiCo that sells snacks, potato chips, they don't grow at 20, 30%. They grow at 5 to 10%. So the first one I showed you is kind of like, you know, the really fast grower, the rocket. This is kind of like the slow and steady turtle in the race, okay? But why do we want to buy these companies? Because they are the most resilient during a bear market and economic recession. So whenever the market collapses, whenever there's a bear market or recession, what happens? These companies, they don't go down, or they go down a bit. In fact, they may even go up, right? So for example, McDonald's is an example of a defensive company. Predictable. Burgers are burgers, right? In fact, during the financial crisis, during the dot-com crash, when stocks dropped 50%, McDonald's went up. Because guess what? Right? In a worse recession, people still go to McDonald's, right? People still drink Coca-Cola. People still eat snacks from Pepsi. Cool, right? So what are some examples of defensive companies, guys? Give me some examples of defensive companies. That's right. Johnson & Johnson, Coca-Cola, Procter & Gamble, Unilever, that's right. Costco, correct. Yum Brands, correct. Yum China, correct. Clorox, yes, correct. Starbucks, not exactly. Hershey's, yes, Hershey's, right? 3M, no. 3M is a cyclical company. 3M is cyclical. Kimberly-Clark, yes. Walmart, yes, agreed. Kraft Heinz, yes, but Kraft Heinz is no longer a great business, right? So, don't ever buy Kraft Heinz, in my opinion, right? Okay, so again, you can see that on February the 28th, I sent an alert to the community. I'm adding J&J at 131. Johnson & Johnson, let's take a look at Johnson & Johnson. Right. So you can see that it was in a big consolidation. Can you see that? You see this consolidation, ding dong, ding dong, ding dong, ding dong, right? So in February, over here, this was February, right? I bought it at 131. So why did I buy it at 131? Because it's undervalued, and you can see that it hit a strong support level over there. So you buy at the support level. So buy over there, all right? And of course, you can sell it over there. You can buy it back, sell it over there, buy it back. I just kept holding on to it, right? Because I use options to sell covered calls at these levels. And the intrinsic value, you can see in green, is 147 to 155. So that's the intrinsic value. So currently, Johnson & Johnson is at fair value. It's not expensive. It's not cheap. It's at its intrinsic value. So it's no longer attractive here. But when I bought it here at 131, it was attractive because it was undervalued and at a support level, right? So sure enough, at 131, I bought it. Now it's 146. Yep, I made not a huge return, but not a bad return as well, right? Making money is always good, okay? Okay, next category are large cap cyclical stocks. Okay, let me explain the difference. When you buy a growth stock, like Amazon and Facebook, right? This is what you see. Okay. When you buy a predictable company like PepsiCo or Procter & Gamble or Colgate, right? It's something like that. Okay. So this is like a lot steeper. This is less steep. Okay. Now, for these companies, cyclical stocks, what does it look like? What do you think it looks like? Remember, every stock category has its own pattern. Okay, so these companies look like that. Whoa, 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 whoa. That's right. These are cyclical stocks. So they go through big ups and downs. Does this make sense? Okay. So for cyclical stocks, you only buy them when they are near the bottom of the cycle. You buy them here and you got to sell them at the top of the cycle, right? These are cyclical stocks, okay? So these are large companies that sell products or services that are highly dependent on the economy, like 3M, like Caterpillar, like Honeywell, for example, like banks, JP Morgan, Bank of America, right? So these companies, they generate a lot of sales and profits during economic expansions, but they also make a lot of losses or lower profits during recessions. So they make a lot of money, lose money, make a lot of money, lose money. Very cyclical, like a roller coaster. So example, real estate developers, banks, commodity companies or material companies, energy companies, industrial companies. So the stock price is highly volatile with long-term peaks and troughs. And like I said, I only buy cyclical companies when they are at the bottom of the cycle. So let me give you an example of one of them which I bought, which are the banks. So in the US, I bought JP Morgan, Bank of America. In Singapore, I bought the Singapore banks like OCBC. You can see this is my alert again, just added to OCBC on the Singapore Exchange with a 5% dividend yield, right? And my position in the 3 Singapore banks is $600,000. I bought 600K worth and I'm building up to 1 million by the end of the year. All right, now it's worth about 700 grand. Okay, now why? Let me tell you why I bought these 3 banks. Let me show it to you, the chart of the banks. There. Okay. So this is the OCBC Bank, which is one of the banks in Singapore. And you can see, whoa, baby. Oh, Nelly, yes. So you can see here's a strong support, right? So I bought there, right? And now I'm waiting for it to go, hallelujah, back up there. So it's a cycle. It's a cycle, right? Another one is DBS, which is the biggest bank in Singapore. Again, look at the cycles. You can see the big cycles. Can you see the big cycles there? So I started buying here at about $19, $18, $19. Now it's going back. And once it reaches about 32, I'm getting out, right? So you catch the wave, you catch the cycle. So every company is different. You have to understand the type of company you're looking at. Okay, so we talked about large cap growth companies, large cap predictables. We talked about cyclicals. The fourth one, can you see this unicorn? Right? These are speculative growth stocks. So in this category, we look at new growth companies that have the potential to become white moat companies that will dominate their industry. But they currently only have a narrow moat. So in other words, right now, they are not a monopoly yet. They still have a lot of competitors, but they have the potential to become a monopoly in the future. But right now, they are not making money yet. They have a lot of debt. So they are still risky. It's kind of like, it's still a baby that's not strong yet. Okay, but there's a lot of hype. And usually their sales revenue is growing at 100%. Okay, but they are yet to make consistent profits. They are not making consistent profits, and their cash flow may still be negative. Company could still be making losses because of high investment costs and lack of economies of scale. All right. So for these companies, the profit is negative. You can't use a PE ratio to value the company. Their cash flow is negative. You can't use a discounted cash flow to value the company. So the only way to value this company is by using what is known as price to sales growth ratio. The price to sales growth ratio, which is you take the price to sales ratio. You take the price to sales ratio. And you divide it by the revenue growth rate. And if it is 0.2 or less, then it is cheap. But if it is way above 0.2, if it's like 0.5 or 0.8, then it's bloody expensive. It's bloody expensive. Does that make sense? Okay. So I'll give you an example in a while of how we calculate that. Again. So this is a higher risk investment as the company will not pass some of the steps yet. Again, may still be losing money, it's got a lot of debt. So would I buy these companies? Would I buy these companies? Well, I would tend to trade them, more like a one-night stand and not really an investment. So the difference is when I go in as a short-term trade, I tend to use options instead of buying the stock. I just buy the options, or if I buy a stock, I'll put a stop loss, and the moment it falls by say 8 or 10%, I'll cut my losses because they are very risky. So you just have to ensure that in your portfolio, you don't have too many of these stocks, because they can make you a lot of money, but they can kill you if they don't work out. So I call this kind of like, in a meal, this is kind of like your hot sauce, your chili. Okay, so it's good to have some chili, some hot sauce to spice up the meal, but if you put too much chili, too much hot sauce, you could get indigestion and you could throw up. Does it make sense? Okay. So I usually take a smaller position. Okay. Now, the fifth category are what I call turnaround stocks. Now, turnaround stocks are great businesses, but have been temporarily hit by some kind of bad news, like a lawsuit or boycott. Like, example, a year ago, Facebook was boycotted people boycotting Facebook, and they were under investigation by Congress. So because of the bad news, Facebook fell by 30 to 40%. And that's when I bought a lot of Facebook shares, right? I bought a lot of Facebook shares. You can see my Facebook shares. Yep, over here, I bought it at about $182. That was when it dropped during the boycott and the panic. I bought it at 182 and now making pretty good profits on Facebook as well. Okay. Another example would be Boeing, right? Boeing was hit by the pandemic and the plane crash. So the share price dropped by 50, 60%. So I was buying it when it was going through all that bad news. And now I'm making money on Boeing as well. Another one is Booking.com. Booking.com is the largest tour agent in the world, right? It's an online tour agent. And because of the lockdown, people can't travel, the profits were hit and the stock fell. And you can see that on the 27th of April, I sent a message to my students. I said, I just bought an initial position into Booking, right? Because I'm betting on the rebound of the travel industry. So I bought it on the 27th of April. At what price did I buy it at? I forgot. 27th of April. 27th of April. Yeah, I bought it somewhere there at about $1,800. So I bought it at 1,008. And of course, oh, sorry, wrong. Not April last year, April this year. My bad, right? Let me zoom to 1 year. Yeah, okay. So I bought it here. That's right. I bought it at $1,400. That's right. Okay, and right now it's at 1,009. So I've made about, let's see. Yep, I've made about 42% return on the stock, and I recently sold half of my position. So why did I sell it? Because you can see that right now there's a strong resistance over there. Can you see this resistance over there? Right? So boom, down, boom, down, boom, down, boom. And right now it is overvalued. You can see it's above the intrinsic value. It's hitting the resistance, so it's a good time to sell to take profits. If it goes back down again, I'm going to buy more. All right. So you can see this was my initial buy on the 27th of April. And this was just 2 days ago. That's right. I said I'm selling at this price. I'm going to exit my position to redeploy to another great company right there. This was just sent out. My alert was sent out just about a day or 2 days ago, right? Okay, the final category would be companies that are known as income stocks. And I call them dividend cash cows. The objective of buying these companies are purely for collecting dividends. So these companies don't expect them to grow very much, right? They could be going sideways or going up slowly, but they pay good dividends of at least 5% a year. All right. So I normally buy these stocks when the dividend yield is at least 4 to 5% a year. They consistently increase their dividends per share for the last 5 years. And of course, they're increasing their net profit and cash flow. And they have got low debt, right? Now, the important thing is when you're buying companies for dividends, only buy defensive and predictable companies. Avoid cyclical companies. Avoid property developers. Avoid banks. Avoid airlines. Avoid shipping companies because these are cyclical. When the economy goes bad, they can't continue to pay a good dividend. Does that make sense? So you want to buy companies where they are defensive so they can pay a higher dividend every single year, right? So does it make sense? These are the 6 investment categories. So I hope that's useful to you. That when you build your portfolio, like I said, you want to have a good balance of these companies. Okay. Now, personally, for me, I would say roughly about 50% currently, about 50% of my portfolio are in large growth companies, about 50%, and about, I would say, 30% are in defensive companies. No, sorry, I would say, yeah, about 20%. Yeah. Cyclical companies, about 20% as well. Okay. And for turnarounds and speculative growth, these are like the hot chili sauce, where they're more risky. So I only allocate 10% of my portfolio to this. And for dividends, to me, it's a totally separate portfolio altogether. All right. So roughly, this is my allocation, but there's no right or wrong. It depends on you. If you're more aggressive, you would have more allocation to large growth and to speculative growth. If you're more conservative, then you want more defensives, more dividends, and less speculative growth. So, like I said, we are all different. We are at different stages of our life, different objectives, different risk tolerance. So you have to build a portfolio that fits your objectives. So in the value momentum investing course, I teach you how to build a winning portfolio that fits your objectives. All right. Does it make sense? So like some people, they need to eat more meat. Some people, they avoid meat. They eat more carbo. Some people avoid carbo. They just eat vegetables. We're all different, right? But you have to understand how to build a winning portfolio. I hope it's been useful so far, guys. We are only halfway through, so stick with me. I've got a lot more to teach you. Okay. All right. So we've asked for your votes. So I said that I'm going to do a live stock analysis today, and we asked you to send in your votes. And these are all the votes that came in, ranked by the number of votes. And first on the list is Alibaba. I'm not surprised because recently Alibaba has fallen 20% because of some temporary bad news. So I'm going to do an analysis on Alibaba for you guys today. And for the rest of the stocks, I will talk about them at the end of the webinar. I'll revisit it and I'll share with you my insights on the rest of the company. Shall we do that? Right. But for now, let's do a deeper dive look into Alibaba. Now, first of all, for those of you who have no idea what Alibaba does, okay, here's a very quick introduction. Okay, there we are. All right. Now, by the way, Alibaba, if you are in the West, you may not be familiar with Alibaba because in the West, you tend to use Amazon, eBay, right? So in China and Asia, Alibaba is the equivalent of Amazon and eBay, right? It's the equivalent of Amazon and eBay put together, all right? Now, Alibaba is listed on 2 markets. On the US market, it's listed as BABA, that's a ticker symbol. And on Hong Kong, it's listed as 9988. Now, which one should you buy? It doesn't matter. You can buy the one in the US or you can buy the one in Hong Kong. It really doesn't matter, right? And here are some interesting facts about Alibaba as an introduction. So Alibaba is the world's largest, let me repeat that, not China, it is the world's largest retail commerce business in terms of gross merchandise value. So in terms of the number of goods it sells, Alibaba is way bigger than Amazon and eBay. And I'll show you the figures in a short while in terms of the value of the goods sold on the platform, right? Now, Alibaba, its main business is into e-commerce, just like Amazon and eBay. But another big part of the business is into cloud computing, cloud enterprise solutions. So it competes with Microsoft, it competes with Google, as well as Amazon in the cloud enterprise space as well. So those are the two main businesses. Now, those of you in the West, in the US especially, you'll be familiar with the Thanksgiving, Black Friday, and Cyber Monday, because this is the biggest sales event for the year in the US. Okay. Now, in the US, if you add up the total online sales during this period, it's 28 billion US dollars. 28 billion US dollars. Alibaba, during Singles Day, which is the biggest day for sales in China, they just recorded $74 billion in sales in one day. So think about it. What Alibaba sells in one day, 74 billion, is more than double of what Amazon and eBay sells for the 5 days combined during Black Friday to Cyber Monday. That's how big Alibaba is. Okay, it's humongous. Now, these are some numbers comparing Alibaba, eBay to Amazon. Now, in terms of, again, total gross merchandise value, the value of the goods sold, Alibaba is now selling $1 billion. Okay, in terms of sorry, not a billion, 1,000 billion. This is 1 trillion. Okay, $1 trillion US dollars, guys, in a year. Okay, now compare that to eBay, 95 billion. Amazon is 335 billion. So even if you add up eBay and Amazon, that's about 400 billion. Alibaba is double the combined value of eBay and Amazon in terms of gross merchandise value. Okay, Amazon has 200 million active users, eBay 66 million. Alibaba has 846 million active users a month. All right. But in terms of revenue, Amazon is still bigger than Alibaba in terms of revenue. Okay, in terms of revenue. In terms of profit margin, Alibaba 22% net profit margin compared to with Amazon's 5% net profit margin. Revenue growth, Alibaba is growing at 46% revenue growth for the last 5 years compared to Amazon 28%, eBay 6%. In terms of market value of the shares, market cap, Alibaba is 600 billion and Amazon is 1.5 trillion. So in terms of market cap, Amazon is still half that of Amazon. Sorry, Alibaba is still half that of Amazon, which means Alibaba has the potential to double in its market value. In other words, the share price of Amazon has the potential to double in value because it's only half that of Amazon, whereas the merchandise being sold is more than of Amazon. Does that make sense? So there's a huge opportunity there. Now, so the first step is to know whether it's a great business. Remember that? So what's the first criteria? That's right. Consistent increase in sales revenue, net profit, and cash flow from operations. So let's take a look at those numbers right now. Let me just skip all these slides. Let me just go to the numbers. Give me a second. Okay, there we are. All right. So this is the revenue of Alibaba. You can see it's increasing consistently every single year. That's what we want, right? Next, net profit, again, increasing consistently every single year. Check. Next, cash flow from operations, increasing consistently every year, check. Passes the first step, right? Remember, I've got 7 steps. That's step 1. Passes step 1. What's step 2? Step 2 is you want a company to have a sustainable competitive advantage, a wide economic moat. Remember that? Okay, so does Alibaba have a wide moat? Yes, it is a brand monopoly in China. Okay, Alibaba is the most valuable brand in China, is China's market leader in e-commerce. Okay, it has top of mind recall among everyone in China and Asia. Network effect, very similar to Amazon and eBay. It's got a network effect, which means that everyone wants to sell on Alibaba because everyone is there. So the more people that sell on Alibaba, the stronger the network effect and economies of scale. It's kind of like Amazon, right? They can sell cheaper than anyone else. No one can compete with Alibaba. They are a behemoth. So it's got a wide economic moat. Now, before you buy a company, you must compare it to all its competitors. And you have to ensure that the competition is insignificant. It's insignificant. Remember, we only want to buy a company that has no competitors or the competitors are insignificant. So the closest competitor to Alibaba is JD.com, right? It's the closest competitor in e-commerce. And if you look at the revenue, JD has higher revenue than Alibaba. It's got more revenue. But if you look at the net profit, JD sucks. Alibaba has a lot more profit than JD.com. If you look at gross profit margin and net profit margin, Alibaba's 45%, 43% versus JD 8%. Net profit margin, 23%, 22% to JD 2 to 4%. So you can see that Alibaba is superior in terms of its profit margins, which is the most important thing. Another competitor is Pinduoduo. Some of you may have heard of Pinduoduo, which is another social shopping platform. And you can see that if you compare it to Alibaba, it's nowhere near Alibaba, right? Much lower revenue, losing money, and negative all the way, right? So Alibaba is the de facto monopoly. So we know it's a great business. Question is, what is the intrinsic value? Would you like to know the intrinsic value, guys? What's the intrinsic value of Alibaba? Was it worth? Is it the time to buy now? Would I buy more now? Is that something you guys would like to know? Yes? Okay. So how do we value a company? Now, before that, another thing is debt. Remember, I told you, only buy companies with little or no debt. Alibaba has a current ratio of 2 times, right? Current ratio would be current assets divided by current liabilities. So Alibaba has double the assets compared to the liabilities in its balance sheet, right? Debt to EBITDA ratio, we want this to be below 3. The lower, the better. It has a debt to EBITDA ratio of 0.8, which is very low, and a debt servicing ratio of 0%. Anything below 30% is good. Alibaba has 0. So what does it mean? It means Alibaba has very, very low debt and a shitload of cash. So it's a very, very financially strong company. Okay. So what is the intrinsic value? What's it worth? Now, one way to value a company is to look at the PE ratio, the price to earnings ratio. That's the simplest way, but not that comprehensive. In the last 5 years, the average PE of Alibaba is 39 0.4 times PE ratio. Currently, Alibaba's PE ratio is 35 times. So based on PE ratio, it is below the historical average, which means it is cheap based on PE ratio. Okay. Now, if you want to be a bit more sophisticated, we compare Alibaba with Alphabet, Amazon, JD, and Microsoft. And if you compare the PE ratio, you can see that it's pretty much the same. But you cannot just look at PE ratio. You have to look at the growth of the earnings. So we calculate the PEG ratio, which is more accurate. Okay. Now, PEG ratio, the PEG ratio of a stock is equal to the PE ratio divided by the earnings growth rate. So if you take this, divide by this, you get 1.7 PEG ratio. Now, what the heck does it mean? Very simple. The lower the PEG ratio, the cheaper the stock is. So you can see that if you compare Alibaba with all the other big tech companies, it has the lowest PEG ratio, which means comparing to the other tech companies, Alibaba offers the best value right now. Got it? Okay. But let's calculate the intrinsic value. And I've already done it, actually. So let me just find that for you. Where did I put it? That is the one. Okay, so Alibaba, you can see that after I've done the valuation, I'm not going to go into detail. This is going to get too long, right? I'm just going to show you the result, right? So the result is the intrinsic value of Alibaba is 2,000 renminbi. Because remember, this company reports in renminbi or Chinese yuan. So you're going to convert it to US dollars. If you convert that to US dollars, the intrinsic value is $279. Or let's round it up to $280. Okay. So where's the share price right now? Let's take a look at the charts. And let's look at Baba. Okay, what's the intrinsic value again, guys? $279 or yeah, $279. So the intrinsic value is, let me just mark it out over here. Let me just get rid of all these lines. Oops, 279. Boom, there we are. So I'm going to mark it out in green to show you the intrinsic value there. Okay, so currently it's selling at 270. So it is undervalued, right? It is undervalued. So it is a possible time to enter the position. Now, the next question would be, is it at a support level? So you can see over there, the breathing pattern. Breathe out, deep breath. Breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. Deep breath. Boom. Can you see that it hit this moving average? Check it out, guys. It hit the 150 moving average and it formed a bullish engulfing pattern. A bullish engulfing pattern is a reversal signal. So yes, this was a time to buy Alibaba on Thursday and early Friday. Right now, it looks like it's going back up again, right? So I repeat, it is undervalued. It's at a support level. It's a time to enter Alibaba. In fact, you can see in my chat group, I notified my students of this yesterday. Where did I put that? Yeah. Well, I can't find it right now because there's a lot of chats over there. But yeah, the signal was sent to my students yesterday, right? To enter there, to catch the wave up. So there you go. Alibaba, great business, undervalued, breathe in, hit the support, now breathing out. There we go. Okay. Now, disclaimer, I already have a shitload of Alibaba shares. Now, I bought the one in Hong Kong, so you can see 9988, that's Alibaba. My average price is 206, listed in Hong Kong. Right now it's at 253, so I'm up about 100,000 Hong Kong dollars in a 2,400 position. Okay. So that's basically how I analyze a stock. Okay. Like I said, at the end of the webinar, which is pretty soon, I will do a Q&A with you guys, and I'll also run through all the other stocks that you voted for. All right. So hang on. Towards the end of the webinar, I will be going through that again. Okay, so great news, guys. During this black market event, we will be having massive discounts across all our courses and our playbooks. And it's kind of like the stock market. When the stock market crashes temporarily, you get a chance to buy great companies at huge discounts, but you got to be fast because it won't last forever, right? So if you're not fast to take advantage, the stock market will eventually go much higher and you don't get a chance to buy it again. So the same thing with, that's what we call it black market, right? Because this is a time when the value of my courses are really high, but temporarily you get to buy at a huge discount, 60 to 65% discount of all our courses. Now, out of all the courses, people ask me, Adam, which is the first course I should take? My suggestion is to take the value momentum investing course. If you feel that what I've taught you today is useful, great. And I believe it has been useful. I hope you've got a lot of insights. But what I can cover today in about 2 hours or so is less than 1%, right? It's less than 1% of everything that you can learn, right? So if you want to go in depth to learn everything about being a really powerful investor, take the value momentum investing course. So this is a course where I'll teach you exactly how to be a very, very consistent, profitable investor. And in lesson 1, you'll be learning all the basics of how the stock market works. Lesson 2, how do you invest in exchange traded funds or ETFs? Lesson 3, the key steps to profitable investing. Lesson 4, fundamental analysis. So you'll be learning how to read a business inside out. How do you know, is it a great business or a mediocre business? Okay. How do you read the financial statements? How do you identify growth potential and danger signs? And great thing, if you have zero accounting background, if you have no experience in finance, don't worry, we start from the basics and we work you to the advanced stuff. At the same time, I've had a lot of people who have got master's degrees in finance, who have got CFAs, who are accountants. And when they came for my course, they said, Adam, I've learned more from you than my 5 years in business school. Because everything I learned in business school, it was not practical. I couldn't use it to really make money in the markets. But with your course, I've now learned how to actually make money in the markets. And today I've got private bankers, I've got financial planners, I've got brokers who are among many of my students, right? Lesson number 5, you'll be learning all about stock valuation. What are all the different ways to value a stock, to know is it expensive or cheap, okay? And I'll also be teaching you all about reading charts, technical analysis, how to time your entries. You know, when to, the exact time to buy, to catch the wave up, when to sell to take profits, how to identify market trends and cycles, and how to use moving average to read changes in trends. Lesson 7, we put it all together in the 7-step value momentum investing formula. This is the secret recipe, right, to beating the market every year. Lesson 8, how do you build a winning portfolio, which I showed you an example of. Lesson 9, how do you find the best opportunities every day in the markets. Lesson 10, all about psychology. How do you wire yourself to go against the crowd, to be greedy when others are fearful. Lesson 11, how do you choose the right stockbroker? How do you use the brokerage platform to execute your orders? Lesson 12, how do you turbocharge your portfolio using options? That's right. Even in the value momentum investing course, you'll be learning the basics of how to use options to turbocharge your portfolio. So it's a complete program for investing. Okay. And these are the many, many students who have done really well learning these techniques. This is Derek. He said, "Dear Adam, before attending your course, I was only dreaming to achieve 10 to 15% investment returns yearly. After employing all your powerful strategies, I managed to capture 65% returns within 6 months. And today, which is almost the end of the year, he's up over 100% for the year. He's an engineer by training, by the way. This is his report from Interactive Brokers. You can see first 6 months up 65% versus the S&P up 15%. If you go to YouTube, you can watch his full interview where he shares about his story of how he achieved these returns on YouTube, right? This is Oscar Schoenberg from Sweden. He said, "Hello, Adam. Buying this course was one of the best decisions I've made in my life. Last year, I didn't have a clue what I was doing in the stock market. I ended 2018 with my portfolio down 17%. I can feel his pain because I was there before in the past, right? In early January, I bought this course, and at the moment, I'm up 43% year to date. Okay. This is Gilberto Guerra, sorry. I'm not sure where he's from. If any of you can identify his flag, guess where he's from, do let me know, right? And he said, "Hi guys, I'd like to show you my account after 5 months of investing." Oh, he's from Cuba or Chile. Is it Chile or Cuba? Puerto Rico? I'm not sure. When I first started, I did day trading, right? And I blew up my account. I was down 32% from day trading. And I missed investing during the March crash. But on April 2020, I purchased the value momentum investing course and started investing in July 2020. So he started late. He only started in July. He only had 5 months, right? 6 months. Since then, my account has been growing consistently, up 38%. Up 38.59% year to date. So think about it. This guy was down 32%. But despite being down 32%, he's still up 38% for the year. And he only took the course in July. Imagine if he took the course at the beginning of the year, or if he took the course 5 years ago, can you imagine how much more his portfolio will be? So the earlier you learn this, the faster you're going to build your wealth and your portfolio. This is Chu Yan Yi from Singapore. Before he attended the class, he lost 70% of his savings, 70% of his savings, because he had no idea what he was doing. He listened to rumors, he listened to friends, his broker, he lost 70%. And 5 years ago, he decided to learn the right way, right? So he took the course 5 years ago, and since then, he has achieved double-digit returns every single year, right? He's up 195% from October 2016 to May 2018. Last year, 2019, he was up 36%. And this year, year to date, he's up 44%. Building his portfolio from about $4,000 initially to now $55,000. Tenfold increase in his portfolio size in just the last 5 years. So in the value momentum investing course, I'm going to teach you how to become your own personal hedge fund manager and how do you achieve the returns of the high net worth investors. So again, how do you buy winning stocks that beat the market? How do you invest in ETFs? As well as how do you invest in real estate investment trusts, REITs? Now, how much do you need to get started investing? Do you need a lot of money to start investing? Not necessarily. The great thing is nowadays, brokers allow you to open an account with no minimum sums. That's right. You can open an account with as little as $500. Okay. And I tell people that if you have small money, should you invest it? Yes. You know why? Because if you don't invest small money will never grow into big money. You got to start somewhere. You can't say, hey, when I got a lot of money, then I'll invest. No, you start when you've got small money, then it will grow and compound into big money. And it's better to invest in small money because if you make mistakes, at least you make small mistakes. So by the time you've got a big portfolio and account, you would have made all the mistakes that you can make, right? And you get brilliant results. That's the point. I'd like to share with you some more inspiring stories. This is from Michael from Malaysia. He said, I started to invest when I was about 16 years old, back when I was in high school, and lost 90% of my savings due to having no mentor. After that, I decided to quit investing due to the fear of losing the extra 10%. During mid-2019, I decided to give investing a try again, only to lose the remaining 10%, right? Poor guy. After discovering Adam and strictly following Adam's advice and learning from him, in 3 months, I've recovered 100% of all my lost savings and exceeded this year with gains. So I'm here to tell you this. It doesn't matter how much money you've lost in the past. If you have made mistakes in the past, you lost money in the past, it doesn't matter, guys. Why? Because the past does not equal the future. The future depends on what you do now. It's the decision you make now. It's the strategies you employ now. It's the actions you take now that will determine your future, your destiny. And it's never too late. The earlier you decide to take charge of your finances, the earlier you learn the skills, right, the faster you are going to be financially free from the rat race. Another very inspiring story is from Kedar Gemir, who's from Nepal. He's a medical scientist. In fact, he shared that he was also working on the vaccine for COVID-19, right? And he said, Adam, from 2011 to 2018, I lost everything. I lost 100% of my savings. Why? Because he had no idea how to invest and he bought the wrong stocks. He bought it at the top and he blew his account. Now, most people would give up. He didn't give up. He said, you know what? I'm going to make it all back. So in early January, he took this course and he said, Adam, in 1 year, I have gotten an 80% return. That's right. He built his portfolio up 80% to 24,000 US dollars in 1 year. You know, people ask me, Adam, must I take your course to learn all these skills? Can I learn it on my own? By reading books, by looking at free videos, through trial and error? Can I do that? And the answer is yes, you can. You can learn all of this on your own. But I can tell you that if you learn it on your own through trial and error, it's going to take you at least 5 to 8 years. You know why? Because I took that long when I was going around in circles, not knowing what to do. I had to make all the mistakes. And the most costly mistakes are the mistakes you make in the market. The most expensive teacher in the world is Mr. Market. Because if you make a mistake with Mr. Market, he's going to take away your life savings. The reason people invest in this course, invest in themselves, in their education, is because they say, Adam, I want to cut short my learning curve. I don't want to spend 5 to 6 years going around in circles, making all the stupid mistakes that people make. I want to learn the right strategy right now and not waste any more time and build my wealth consistently. So I can tell you that when you invest in this course, you're investing in yourself and you're investing in your time. So what takes people 10 years to achieve, you're going to master it in a matter of months. And this is not from me, this is all from my students, right? So like I said, we've got this great black market sale, a chance for you to buy these great courses at crazy discounts that you will never see again. Okay. So here are the bonuses we're giving out for today's webinar. So good thing you guys stay, right? Okay, so bonus number 1. When you enroll today, you'll be getting all my trademark investing tools. You'll be getting the intrinsic value calculators that's used to value all the different companies, a portfolio manager to track your investments and to help you to create the best balanced portfolio. It's in all this software that we have, and a transaction diary. Bonus number 2, you will get a lifetime access to our investors chat group, where we have got a very supportive community. 7 days a week, over 20 hours a day, I'll be in the chat group with my students and my mentors. So anytime you got a question, we're there to handhold you. We're there to help you in this journey, because investing is a very lonely journey, and to do it yourself is really tough. You get lost, you get discouraged at times, you get confused at times. But when you got people there every day to answer your question, to encourage you, to push you, to share your joy, you can keep going. All right. These are screenshots from our chat group. As you can see, it's a very friendly community. This is Pat from the US. I want to say that if it wasn't for Adam's directions, regular videos, posts, and motivational emails, some of us would have made huge mistakes when this madness started, referring to the crash in February. The media was so negative. Many of my friends panicked and sold. I hope you know, Adam, how much we value your input. There's a great community of everyone in this group. This is Sergio Flores. Adam, your wisdom has saved us and at the same time made us a lot of money. You are one of a kind. Consider myself one of the very fortunate ones to be part of your great teachings. Keep up the great work. All right. And this is Eduardo Lopez. I'd like to thank Adam and its teachings. Year to date, I'm up 33%, even after going down almost 40% when COVID-19 hit. All right. This is Alan. I think it's from the US as well. And he said, this is what will happen when you apply the VMI principles. It is quite visible from the attached image I used to have no clue. I had no clue what I was doing in the stock market. After applying the principles in January, things have literally taken a different direction. And you can see all our community cheering him on, right? So we've got a very supportive, loving community who's there to cheer you on. And if you look at Alan's portfolio, you can see that, it was going down and he took the course in January. Now, is it a coincidence? Is it a coincidence that after this course, hallelujah, it's not a coincidence, because he totally restructured his portfolio. He sold the lousy companies. He bought the great companies. He bought at the right time, and boom, that's how you build your portfolio. All right, so here's what you're going to get in the value momentum investing course. You ready, guys? So you'll be getting a lifetime access to all the lessons, altogether 12 lessons, over 18 hours of teaching. All right. You'll be getting dedicated email support, the trading and investing tools, the exclusive access to the chat group. Okay. So the total value is $3,299 US. And the normal course fee is $1,799, right? So $1,799 US. Now, don't worry, you won't have to pay 1,799 because in a while, I'm going to show you a crazy bundle, a crazy deal that's going to blow your mind. That, you know, it's a no-brainer deal, right? So usual price, 1,799. Now, not only that, for today's webinar, we're going to throw in a 1-year subscription to the Ultimate Investors Playbook. Now, what's the difference? Okay. The value momentum investing course is a course. It's a course where I teach you how to invest. I teach you how to cook your own food. But the UIP, the Ultimate Investors Playbook, it is not a course. It is not a course. It is a subscription where I will cook for you, right? You come to my restaurant and you get a buffet spread of what to eat. Does it make sense? So the course, I teach you how to cook. This subscription, I cook for you, okay? So I do all the work. So basically what happens is every month, I will identify at least 2 great businesses. We do a deep dive research where I'll present to you everything about the business so you understand the business inside out, okay? And you get to mirror my live portfolio. So every time I buy something, you get an alert immediately. I bought this at this price with the screenshot. When I sell something, you see it immediately. So what does this look like? Let me show it to you right now, okay? So for example, there we are. On the 27th of August, that month, I made a presentation on the 3 Singapore banks. And I said that, and you can see these are all the things that we go through. These are all in video, by the way. We go through a deep dive research into every company with competitor studies and so on and so forth. And my buy point was there, all right, showing you all the buy points, as you can see. And right now, as of today, these 3 banks are up about 14% so far in the last 4 months, right? So this was on Singapore banks. Another one presented was on Nike. There we are. So this was on 31st July, we presented Nike. You can see we go through again the entire research into Nike with the competitor analysis and valuation and everything. And the buy price at that time was $96 on Nike. So since we presented that at $96, right, you can see Nike is now at $102. That's $132. From $96 to $102 is up over 30% in just a couple of months. So again, every month I'll be giving you all these presentations on the best investments that I'm making in my own portfolio, okay? So you will get exclusive access to my personal portfolio, to my watch list, and you'll also be given live alerts whenever I buy and sell. So you can see during the February crash, these were all the alerts I gave. March 25, bought MasterCard at 236, bought Estee Lauder at 158. March 26, bought Ping An Insurance at 75. Added Facebook at 159 on 30th of March. So you can see these were all the alerts given during the crash, buying right at the bottom. And that's how my students got huge returns from the market. This was Estee Lauder, bought at 196. And right now, Estee Lauder is at 259, and we just took profits on Estee Lauder. This was an alert given on the 17th of November. This was Yum China. You can see breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. We bought at $42 on 27 January. of this year. This was the alert given on the UIP alert chat group. We bought at 42. And where's the stock right now? Let's take a look at Yum China. And right now it's at $60. Okay. This is Christian Arias. He said, "Hi Adam, I want to thank you and your team as I took the trader training and value momentum investing last year after losing 50% of my account and being myself the CFO of a rather large company." So imagine this guy's a CFO of a large company and he lost 50% of his money investing in the stock market. After taking the course, I'm up this year by 98%. Counting today, big day. It is interesting because I've done a survey among my CFO colleagues and it seems that nobody has been able to be profitable in the markets despite their profession. All right. This guy says, "Nice, I'm going through Adam's report. I'm amazed by how much content they create for just 1 month." All right. So you're going to get unbelievable value on this. This is Desmond from Singapore. "Appreciate Adam. I'm one of the beneficiaries for being your student. In the last 1 month, I made $66,000 US in one freaking day." Right? So I can tell you that this investment in yourself is the best investment you can ever make. Because before you buy a stock, before you buy Bitcoin, you have to invest in yourself because no one can take this skill away from you. No one can take this knowledge away from you. And once you learn this knowledge, you will make back your investment very, very fast and you'll pay dividends for a lifetime, right? This is Adeline from Singapore. "Thanks, Adam. I've earned back my course fees, all right, with my portfolio up 6% and another portfolio up 20% when buying all the VMI approved shares during their lowest points. Arigato, Sifu, for everything. And also thanks for everyone, especially the gurus, for their continuous support." Okay, so for the Ultimate Investors Playbook, the subscription, you'll be getting 12 monthly premium reports, at least 2 stock ideas a month. You get to gain access to my watch list, my portfolio, and you get a special Telegram group that alerts you to my buys and sells live. This is worth $6,600 a year. And the annual subscription fee is $1,800. So remember, the VMI cost is $1,004. Remember that? This is $1,008. You get both today. You get both the cost and the subscription today for only $1,259. This is a freaking steal, right? Grab it while it lasts. Okay. So right now in your chat group, you should see a link being posted there. You can click on the link where it will bring you to the enrollment page where you can enroll and you can pay using any of the major credit cards. I think with PayPal as well. Or take out your phone, your camera, and you can use your camera to capture this QR code. They'll also bring you to the enrollment page, right? And again, it is only $1,259, $1,259 US dollars 65 cents for both the VMI course and the Ultimate Investors Playbook. It's a steal. It's the lowest price you can ever get. Grab it, okay? And if you've got questions on enrollment, my team will be there to help you with your questions. Now, some of you will be asking, "Hey, I already have the VMI course. I want to buy the playbook. Do I get a special discount?" Yes, you do. Let my team know and they will help you as well. Some of you may say, "Hey, Adam, I bought the UIP subscription. I want to buy the VMI course. Can I do it?" Yes, you can as well. So again, all these questions, my team will be helping you depending on your needs. Yep, it's the best deal of the year, you bet. All right. So I'm going to take a 5-minute break. And during this 5-minute break, remember, take action. All right, click on the link, go to the enrollment page, grab this opportunity. Just like the stock market crash, grab it at this crazy offer. All right, you'll never get a better one, right? So in 5 minutes, I'm going to come back and I'm going to do a Q&A, and I'll go through the rest of the stocks that you have brought up and share a lot more with you guys in 5 minutes. All right, guys, so I'm back. And let me run through the other stocks that you have brought up. And for the rest of you, you can continue your enrollment. And for the rest of you who are enrolling or waiting for your purchase to go through, let me just run through. Oh, I forgot to mention this as well. Sorry. For the first 50 people who enroll today, you will also get a bonus. You will get a lifetime subscription to my Value Momentum Investing newsletter. So this is a newsletter that I write once a month that I send to my selected students, and it's about 15 to 20 pages a month where I do an analysis of the markets as well as I talk about investment opportunities. So again, you'll be getting this every month for the rest of my life, okay? And again, only for the first 50 people who enroll. So grab it, while it lasts, okay? And again, remember that we also have massive discounts of all our other courses. For those of you who want to check out our options course, as well as our stock trading course or Forex courses, they're also on a discount. And remember, tomorrow I will see you guys again, where I'll be focusing on swing trading, on short-term trading, and how do you generate a consistent monthly profits from trading. That's tomorrow, okay? I like to ask people this question all the time. I always like to ask them, 5 years from now, 10 years from now, where will you be? I don't know about you, but I find that time passes very fast, that at the blink of an eye, a year passes. Like this year just went by in a flash. I know that in 10 years, I'll be 56 years old. Like it or not, time will pass. You will be 10 years older. And again, before you know it, 10 years will pass. But the question is this, 10 years from now, where will you be? Do not leave it to chance. If you don't have a plan for your life, someone else will have a plan for your life. And you'll fall into someone else's plan, and other people may not have anything good planned for you. Okay? So 10 years from now, 5 years from now, where will you be? Will you be financially free from the rat race? Will you be financially secure? Or 5 to 10 years from now, will you still be in the rat race, struggling financially, in debt? Where will you be? And I can tell you that where you will be in 5 to 10 years has little to do with the government, has little to do with luck, but it's got to do with the decisions that you make today. There's a saying that it is in the moment of your decision, your destiny is shaped. It is in the moment of your decision that you shape your destiny. We all have one power, and that's the power to choose. We all have that power. And every day we have a choice. We always have an easy choice and a difficult choice. The trouble is most people, they always take the easy choice. And the easy choice is always do nothing. The easy choice is blame someone, give excuses. The easy choice is hope for the best, all right? And that's when the future becomes uncertain. But the difficult choice is to take ownership, is to take charge, to take responsibility of your financial situation, is to take charge of your life. The tough choice is to keep stretching out of your comfort zone, is to keep growing, is to keep upgrading yourself, is to keep learning, is to take massive action. Today I can only encourage you, I can only entertain you, I can only enlighten you. That's all I can do. I can't make you take action. I can't make you learn this stuff. I can only open the door, but you have to walk through the door. And I do hope that you take action and you make that tough choice. Because the tough choice today is the choice that's going to set you free in the future. And I look forward to teaching you everything I know in the courses and being there, coaching you, guiding you in the chat groups, in the subscription, in the UIP and all those things. Because so many people have come from all walks of life, from Vietnam to Cambodia to Argentina to the US to Singapore, and they all come from different backgrounds. Half the people who have come for the program, they know nothing. They have never invested before, and now they're getting double-digit returns. The other half of my students have invested before, but only half of them have made money. The other half have lost money in the past, but now they know how to make it all back. They know how to turn it around. And those who have made money before were only making 5 or 6 or 7%. It was not consistent, but now they know how to become consistent. So today is the choice. And I always say that if you don't start today, when will you start? When is there a better time? There's no better time. The earlier you start, the faster you're going to get there. All right. So I hope that that inspires you a bit. All right. And now let me just run through. Oops. Let me run through those stocks that I promised. Okay, so let's run through them right now. And again, please feel free to make your comments. Okay. Okay, so Apple. Now, first of all, guys, remember, people like to ask me, Adam, what do you think of this stock? Should I buy the stock? Should I sell the stock? The first question you're going to ask yourself is, what category does it fall under? Now, let's do a quick review. Remember, when you buy a stock, it's like, you got to ask yourself, okay, is it protein, carbohydrates? Is it chili sauce, right? So first of all, is it a large cap growth company? Is it a predictable company that is boring, but it balances the portfolio? Okay. Is it a cyclical company that we buy at the bottom of the cycle to catch the wave up, like the banks? Is it a speculative growth company that's like the chili sauce? But you got to be very careful on those. Is it a turnaround company like a Boeing that's turning around, or 3M or Booking.com? Or you buy it for dividends? So what is your intention of buying something? And does it fit into your portfolio strategy? And again, if you're buying something for growth, if you say, okay, I'm buying this stock for growth, then you have to compare this stock with all the other growth stocks and ask yourself, which is the best one that's offering you the best deal? Because in your portfolio, you may only want to have, say, out of 10 companies, you want to have 5 growth companies. But there's so many growth companies. There's Amazon, there's Alibaba, there's Facebook. So out of all of those, you want to choose the best 5. So you compare them with the rest. Does this make sense? Okay. So let's run through these companies together. Okay, first one, Apple. What's your vote? Is it, which one is it? What do you think, guys? Number 1, agree. It's a large growth company, right? So Apple's a great company. The only trouble is Apple currently is still overvalued. It's too darn expensive. Okay. Now I bought Apple before the share split. I bought it at about $140 and I sold it at about $450. So I more than tripled my money in Apple. So I no longer hold Apple shares. I sold it and I'm waiting to buy it back, right? But it's still too expensive. So after the share split, the intrinsic value of Apple is roughly about $85. So right now, Apple's about $120. It's too darn expensive, right? So I'll only buy Apple if it goes near $85. Okay. Some people are saying that they can't see my presentation. Is that correct? You guys can't see my slides? No, I think you guys can see my slides. Yeah, you can see. Yeah. Okay. Okay. How about Tesla? Tesla is always brought up every year. Which one do you think is? One, two, sorry, that's 5, that's 6, this is 6. Yeah, that's right. So Tesla stock is a speculative growth stock. That's right? And like I said, Tesla is overvalued. There's a lot of debt. And in the electric vehicle market, there's a lot of competition. There are a lot of competitors there. Okay, so as investment, to me it's a bit risky, but I take it for a short-term trade to ride the trend. Okay, so you're right. It's a speculative growth stock. So don't put too much into it, but just have a small allocation. How about Amazon? What do you think, guys? One, yeah, large growth stock. Amazon's a great company. Currently, Amazon, I would say, is slightly undervalued. That's right. I said it. Amazon intrinsic value is about $3,600 to $3,800. 3.6 to 3.8. That's the intrinsic value, right? So the current price at 3.1 or 3.2 is slightly undervalued. Okay. But remember, before I enter, I don't just look at the valuation. I look at the charts. I want it to breathe in to a support level before entering, right? So I already have a lot of Amazon shares. So I'm not buying it. I'm waiting for a deeper breathing in to be more undervalued before I add more Amazon. But I tell people that, okay, if you don't have any Amazon shares yet, you have none, sure, you could nibble, right? Just have a small allocation, but I wouldn't buy too much right now because I want to get a bigger discount on Amazon. Okay, how about Zoom? Yeah, Zoom's definitely a speculative growth stock. Again, Zoom is a stock that's good for trading. For one night stand, I wouldn't get married to Zoom. Number one, it's too darn expensive, it's overvalued. And number two, the business model and the technology can be easily replicated. That's right. Although now it's really popular, we all use Zoom, but I feel that the technology can be easily disrupted and replicated by a bigger player in the future. So there is a threat of a bigger player like Amazon or Microsoft disrupting Zoom, and then that's it. All right. Adobe is again number one, right? So most of the companies that you guys brought up are growth companies, right? So again, Adobe is a great company, but slightly overvalued. Okay, slightly overvalued. I would say the intrinsic value is about $400. So I'll only buy it below $400. Some of you are asking, how do I know what's the intrinsic value? That's why you got to come for the course. In the course, you're going to learn how to calculate the intrinsic value and all your dreams will come true. Because if you don't know what's the intrinsic value, you're flying blind. It's like flying a plane blind. But when you know the intrinsic value, you know what it's worth. Okay? Okay, how about AMD, Advanced Micro Devices, semiconductor company? 1 to 6. What do you think, guys? Well, semiconductor, I classify them under cyclical companies, right? They are cyclical companies. And I personally don't have much confidence in AMD because I think that they've got a lot of strong competition from NVIDIA and from Intel, right? In fact, the whole semiconductor business, right? Intel, NVIDIA, Qualcomm, Samsung, it's very competitive, right? So I don't like industries where there's so much competition, all right? Because you can't tell who's going to win in the end. So I don't like AMD for that reason. Okay, Boeing. Which one's Boeing? Now, Boeing, before the plane crash and before the pandemic, it was a large growth and a predictable company. So Boeing was a great company, predictable large growth, but since it got hit by the pandemic and airlines are not ordering planes anymore and the order book is falling and the plane crash, it's now a turnaround stock, right? It's a turnaround stock. So turnaround stocks are more risky, and because Boeing currently has a lot of debt. They've got a lot of debt, and they're still not making money. So it's a bet on it turning around. So for these companies, I only buy them when they are 40% below valuation. If they are not, I would not take that risk. So when a company is very uncertain, I need a big discount to valuation, a big margin of safety to be worth my while, right? So Boeing's intrinsic value is roughly about 250, 260, which means I will only buy Boeing below 150, all right, which I already did, right? So I bought Boeing below $150, making money. But would I buy at today's price? No, because right now I would say that it's no longer cheap enough to be worth the risk. Okay. Okay, Facebook. How about Facebook, guys? What do you think about Facebook? 1 to 6. What do you think? Yep, large growth. Number one again. Facebook, great company. I would say it's fairly valued. It's not overvalued. It's not other. It's fairly valued, right? So I've got a lot of Facebook, and I'll only add more shares if it breathes in deeper. Okay. Fastly. Fastly is another software company. Fastly is number 4, speculative growth, right? Only good for trading. I wouldn't invest in it because again, it's overvalued. It doesn't have a strong economic moat. There's a lot of competition in that industry. Intel. How about Intel? Intel is similar to AMD, right? Cyclical company. Big cycles, right? Look at the chart, big cycles. So Intel right now has dropped quite a bit, and Intel is very undervalued right now. It is undervalued right now. I would say I wouldn't say Intel's a great business. It's an okay business, and it's cheap right now. So I would say Intel is more of a turnaround stock. Turnaround and cyclical stock. So I personally have not bought Intel. I don't intend to buy it because it's not that exciting to me. But there's no harm buying it for a bit of a turnaround. Okay, I think there's still some room for it to turn around. And the reason I don't like Intel is because, like I said, I don't like to invest in the semiconductor industry as a whole because it tends to be very competitive and very cyclical in nature. Okay. Microsoft, we've covered that. So let's move on. Nike. How about Nike? Which one is Nike, guys? Nike is predictable. Why? People will always need running shoes, right? It's predictable and it's a growth company as well. Okay, so I love Nike, right? But right now, Nike is too expensive, overvalued. All right, so we needed to breathe in to buy shares. So I already bought Nike at $90, right? So now I'm up about 30%. I wouldn't buy more right now. In fact, right now I may even take some profits on Nike. I sold some covered call options on Nike as a way to take some profits off the table. Okay, how about NIO? NIO is an electric car company from China. NIO is against speculative growth. That's right. Okay, so NIO is very similar to Tesla. Okay, you could trade it, short-term trading, investing. It's a bit risky. Okay, NVIDIA is a semiconductor, but they've got a niche into graphic processing units, GPUs for gaming consoles. So they've got a very strong niche there. And NVIDIA is a large growth company. But trouble is way overvalued. It's really expensive right now, right? So it's got to drop at least 30% before I would buy anything. Pfizer, I guess because of the, not Viagra, but because of the vaccine. So Pfizer, which company, what would you classify under Pfizer? Yeah, Pfizer's cyclical, that's right. It's very cyclical. If you look at the stock price, is very cyclical, absolutely. Personally, for me, I never like to invest in drug companies. I never like to invest in drug or pharmaceutical companies because their patents on their drugs don't last long. It lasts for 10 years. The drug expires, and they have to keep making new drugs. And if the new drugs fail or don't get approved, the share price drops violently. There's a lot of gaps in the price. So it's a very unpredictable business. And that's why I avoid drug companies. Okay, finally, Square. Square is a mobile digital payments business. Square is speculative growth. That's right. Yeah. In fact, it just started making money, right? It started making money, but it's way overvalued. Again, Square has to drop 30%, at least 30% for it to be worth the money. Okay, but again, Square is something where there could also be a lot of competition in the future. All right, so great for trading, but for investing, I wouldn't put too much into that. All right, so I do hope this has given you an insight into how you analyze stocks. Remember, when you buy a stock, you're not buying a lottery ticket, you're buying a business. If the business does well, the stock will do well. It's as simple as that, right? So the key, buy good businesses that are rising in value. If the business rises in value, the stock price will always go up, always. But temporarily, it can drop because of manipulation, bad news, and that's when you buy it, when it hits a support level. All right. So I hope you learned a lot today, guys. And if you got any more questions, do send us an email. We'll help you, and my team will be online continuing their support to help you enroll in this bundle, right? So once again, this is the QR code for those of you who need it again. So you can capture the QR code. It's $1259 US for both the VMI investing cost worth 1,004 and first year subscription to UIP worth 1,007. So it's 355, 3599. You're getting 65% off, 1259. Right. So thank you for joining me. Remember to join Elson's webinar. He'll be talking about price action manipulation. Elson is the master in understanding how market makers and banks manipulate the markets and how he takes advantage of the manipulation to pull profits out of the market. Right? He's one of my best friends, one of the traders I admire tremendously. Go learn from him. And also do attend Bang's webinar on how he trades options as well. The guy's an options genius. I've learned a lot from him. And again, I'll see you guys tomorrow for my trading segment, where I'll share with you one of my extreme trading strategies, which has helped me to generate consistent profits every single month. So with that, see you guys soon. Take care, and God bless. Take action.